What is good, trading family? It's your boy Wildcard back in the booth on this Saturday deep dive. And I've got the walking quantitative encyclopedia, the man who speaks in standard deviations, TB, right next to me. We are live, we are loud, we are locked in, and we're about to take a full forensic tour of the week that was. No headlines, no surface level recap. This is the autopsy. Pull up a chair, pour yourself something strong, because we are getting into the guts of a week that looked quiet on the surface, but was doing backflips under the hood. We're talking a dollar that wouldn't stop leaking, semis that got absolutely shellacked, a jobs report the robots loved and the humans should be side-eyeing, and a rotation into real economy names that has my system and TB's system staring at each other from opposite sides of the boat. TB, lay out the headline tape for the family.
SPY, the S&P 500 ETF, closed Friday at $744.78, up 2.17% on the week. That's the quiet number that makes people think nothing happened. But Q's, the NASDAQ 100 tracker, closed at $712.53, up 0.7%. Russell 2000 IWM finished at $297.58, up 0.3%. So the broad index barely budged, but the aggressive growth and small cap pockets took real damage. The gap between SPY and Q's, nearly 1.5 percentage points of relative performance, tells you capital left high beta tech and found a new home. That rotation is the spine of everything we're about to discuss. It wasn't a risk on melt up, it was a defensive reshuffle wearing a neutral mask.
And the reshuffle didn't just show up in equities. You saw it in currencies, in hard assets, in commodities. The dollar spent the entire week on its back foot, and when the dollar weakens, it rewires the pricing of everything denominated in it. Bitcoin, which we track as a live sentiment gauge for both speculative appetite and hard asset demand, closed at $62,428.52, up 3.81%. Gold, we don't have a precise tape number, but the yellow metal ripped higher. Oil, meanwhile, spent the week under pressure, sliding when history says a softer dollar should have given it a bid. That divergence is the signature of a dollar that is no longer the automatic reserve currency default in traders' minds. Hard assets caught a bid, dollar-priced commodities compressed. Money was changing addresses, and the dollar was the moving van. TB. Take that framework and marry it to what we saw in semiconductors, because the correlations that broke this week are the most important signal on the board.
Normally, a weakening dollar is a tailwind for large multinational revenue streams. Micron, ticker MU, derives roughly 60% of its sales from outside the United States. A falling dollar should translate to a translation benefit. Instead, Micron closed Friday at $134.23, down 14.36%. Wolfspeed closed at a price not available in our briefing, down 9.71%. Applied Materials finished at a price not available in our briefing, down 7.31%. These are not dollar-driven moves. They are thesis-driven moves. The correlation between the dollar and semiconductor equities broke down hard this week, and that tells you traders weren't selling because of macro concerns. They were questioning the artificial intelligence demand narrative itself. Right as that selling accelerated, Bloomberg ran a piece. Artificial intelligence trade is losing one of its key signals. We don't know if it was flagging data center capex growth rates, or book-to-bill ratios, or some leading indicator of cloud demand, but the headline landed like a brick. That kind of thesis break does not get healed by a cheaper dollar. It gets healed by order data or earnings that prove the doubters wrong. So while SPY held up, the pain was concentrated in the highest beta pockets of tech.
And here's where the rotation gets even more textured, bro. This wasn't a uniform tech sell-off. Look at the mega caps. Apple closed at a price not available in our briefing, up 12.23% on the week. Microsoft shut the week at a price not available in our briefing, up 9.34%. Those are fortress balance sheets, cash-rich machines that traders treat as the haven within tech. But then you look at Meta, and it got caught in the downdraft, up 7.28% to a price not available in our briefing. So the money didn't abandon tech entirely. It fled the highest, multiple, most AI-levered names and parked itself in the mega-cap earners that can weather a growth scare. That is not a sector collapse. That is an internal maturity check. The tape is screaming, show me the return on all that capex, or I'm hiding in the proven cash cows. And TB, that is exactly the environment where your wave trader system is standing in the fire. You're holding 4 semis that got absolutely body slammed. Walk the family through the damage. No sugar.
No sugar. My wave trader system holds 9 open positions. 4 of those are semiconductors, and all 4 took real pain. Micron entered June 30th, down over 5.5% just this week. Alpha and Omega Semiconductor, AOSL, got vaporized, down 14.54% on the week, closing at a price not available in our briefing. That's a small cap semi that got taken to the woodshed. Applied Materials slumped 7.31%. And Wolfspeed, which I entered on July 2nd at a price not available in our briefing, closed at a price not available in our briefing, down 9.71% on the week. That is maximum pain on a thesis that says artificial intelligence infrastructure demand is real and persistent, and that this is a correction within a secular build-out, not a regime change. The system is staying patient. On Friday, the pipeline screened 318 signals and took 0 entries. 286 were gated for weak prospective gain. Many short-term moving averages had collapsed, and the system read that as noise, not opportunity. So I'm sitting here with the bleeding positions, holding on conviction, not on price action. And Ryan, your TFT system did the exact opposite going into the holiday.
That's right. And I love the contrast because it's not a fight, it's texture. My TFT system saw the same rotation data and decided to bet on the real economy catching up. On Friday afternoon, with holiday liquidity thinning out, it added a whole basket of cyclicals. Caterpillar, at a price not available in our briefing, down 3.02% on the week, but a monster industrial. Parker Hannifin, PH, at a price not available in our briefing, basically flat. Bank of America, up about 0.5% at a price not available in our briefing. Airlines, Southwest, LUV, at a price not available in our briefing, off less than 0.5%. Delta, DAL, at a price not available in our briefing, down just a sliver. And then a handful of laggard tech and industrial plays that could catch a rotation bid. Intel, down 5.1% at a price not available in our briefing. Rockwell Automation, ROK, off 2.26%. Taiwan Semiconductor, TSM, down 1.95%, and Roku, ROKU, actually up 1.32% on the week. That basket is a direct bet that the spread between SPY and Qs is the early chapter of a bigger shift. That industrials, financials, transports, and forgotten old-school tech start to lead if the economy stays out of a recession and the artificial intelligence trade takes a breather. One system is buying the rotational breakout. The other system is buying the artificial intelligence dip. In 7 days, the tape will tell us which lens was cleaner.
And before that lens resolves, we have to talk about 2 stories the market is completely ignoring right now. The first is Blue Owl. The flagship private credit funds at Blue Owl disclosed $4.7 billion in withdrawal requests. That's not a rounding error. That is a redemption test for an entire asset class that has been marketed as safe, steady yield for 2 years. When pension funds, endowments, and sovereign wealth vehicles start pulling billions from private credit, it smells like a liquidity squeeze building in the institutional plumbing. And because private credit doesn't mark to market daily, the stress accumulates in the dark. If forced selling eventually hits to meet those redemptions, it lands first on the most liquid public assets, the large cap stocks and ETFs that we hold in our own accounts. So this is a slow burn risk that can catch fire fast. And right now, the tape hasn't priced in a single basis point of it. The second story is the Venezuela earthquake. Over 2,595 people dead, the strongest tremor in a century, and oil still slid. That tells you supply abundance is completely overwhelming every geopolitical headline. But infrastructure damage, refinery downtime, and LATAM export disruption are accruing beneath the surface. Markets that are in a macro-driven mood like this one digest physical world events on a delay. The quake didn't move oil this week. It might move oil and reinsurance pricing next quarter. Both of these stories live in the blind spot of an algo-driven tape, and that's exactly why they matter.
Bush. And that brings us to the jobs report, which was a masterclass in the tape pricing. One thing, while the humans should be watching something else entirely. Headline came out Friday. Unemployment ticked down, and the algo herd breathed a sigh of relief. No rate hikes. Powell stays chill. But peel back one layer, and the labor force participation rate dropped to levels we haven't seen outside the COVID era. That means people are leaving the workforce entirely, retiring early, giving up, disappearing from the count. The market loves that because fewer workers equals less wage pressure equals a happy Fed. But the human reality is a shrinking labor pool that reduces the economy's productive ceiling. It looks good for 6 months, but it is a structural headwind that kicks in year 3. And the wrong side trade? Nobody is modeling? If participation snaps back because households run out of savings and are forced back into the job market, you get a temporary jump in the unemployment rate that hides real healing, and then wage competition returns, forcing the Fed to pivot hawkish. Nobody has that in their pricing models. TB, from your Fed lens, did the market read this correctly?
The market read the immediate Fed reaction correctly, but it's a one-dimensional read. Lower participation gives Jerome Powell cover to stay patient, and that backdrop supports risk assets and the rotation into cyclicals. The market is not wrong for the next few months. The danger is the complacency around a variable that can reverse slowly and then all at once. If millions of people re-enter the labor force because inflation compels them, the labor supply surge initially pushes up the reported unemployment rate, which gets spun as weakness. But underlying that is a healthier labor market that eventually reignites wage pressure, and that forces the Fed back into a tightening conversation. Right now, the options market and the Fed funds futures market are pricing none of that tail risk. So the dovish read is correct for this week, but it's built on a foundation of people dropping out of the workforce entirely. That is not a strong foundation, and it will matter when the second derivative flips.
Two-step, right there. The surface number and the undercard story. That's the whole week in a nutshell. So let's pull the threads together. SPY barely moved, but under the surface, the dollar weakened and shoved capital into hard assets like Bitcoin and gold. Oil slid. Semis got obliterated on artificial intelligence thesis doubts, while mega-cap cash machines held the fort. The rotation into cyclicals and value pockets got real. My system bought it. TB's system is riding the semi-pain. And while all that was happening, the market looked away from a private credit stress test at Blue Owl and a massive earthquake in Venezuela that will leave marks later. The jobs report gave the all-clear to the bullish algo crowd, while the participation cliff kept lowering the long-term ceiling. Next week, we are staring down a holiday-shortened set. Tuesday opens with thin liquidity. So any stray headline on Iran-Doha talks or a surprise macro print can get amplified. Wednesday, the CPI ticker. That's $25.20. Not the consumer price index, drops right into this dollar weakening regime. If the print shows further cooling, it validates the dovish backdrop and could feed more rotation into cyclicals. If it comes in hot, the dollar could catch a snapback bid and unwind some of the moves we just lived through. We're also watching the Iran-Doha negotiations. Any framework on Hormuz transit or oil supply normalization resets energy expectations fast, and critically, we are watching the semi-momentum corpse. If names like Micron and Wolfspeed keep bleeding without a bid, that Bloomberg key signal piece starts smelling less like a warning and more like a regime change. TB's wave trader conviction gets tested, my cyclical bet gets tested, and we will be right back here next Saturday. Same booth, same no-sugar honesty, to dissect which thesis the tape validated. Until then, trade safe, trade smart, and never let the surface number do your thinking for you.
And a final reminder, nothing we say is financial advice. Do your own research. We are two traders with systems and opinions, sharing the tape as we see it. We'll see you next week.